okay? And of course, as soon as I start the recording, I always have to remember something that I didn't get ready, which is my little clicker. So it makes the recording more entertaining because you get to hear me looking for my clicker or whatever it is that I forgot to do. Is this wonderful? Okay, good. Okay, so what the hell is that? Oops, sorry, I tried, probably when I blew on it, that's what killed it. Okay, all right, so I tried to save him by just getting him to fly away. He didn't do it, now he's dead. Okay, so let's just go ahead and let's take a look at this question, which is maybe the one question that I might put on your midterm related chapter 1A. Remember, it was very basic stuff, okay? And what we said about managerial accounting is we're using it for what? Planning and control decisions. Okay, so chapter 1A, I wouldn't worry about that at all. I might ask you some question. It's very simple like this. Okay, all right, so let's jump ourselves into chapter 1B. Okay, and 1B is going to be the more material part as relating to your midterm from chapter 1. Not chapter 1A so much, but chapter 1B. Okay, now some of this you probably recognize from managerial accounting, accounting 101, and that's going to be the case, hopefully you'll recognize it, that's going to be the case for quite a bit of the material in this class. However, you're going to see that we're going to go ahead and take you a little bit deeper, a little more complex into many of the concepts that you're familiar with from Managerial Accounting 101, Accounting 101 here at SF State. When we're looking at this discussion here of direct cost versus indirect cost, etc., the gathering of costs, it's important that even though we're in a class dealing with cost accounting, we still really have our foot in external reporting to a large extent. And that as a, we tend to teach you in intermediate accounting and whatnot is the external reporting for a retail entity, for a merchandising entity, say Nordstrom or something like that. When we get into cost accounting, yes, we're teaching you how to use accounting to make the decisions and whatnot that we talked about in chapter 1A part of chapter 1 here, but we are also talking about how to gather costs in a manufacturing entity, because the manufacturing entity has to gather costs that then parlay into what? Parlay into their inventory, and then once we have inventory, then we can do things very similarly to how a retailer would, who is purchasing their inventory already manufactured. Okay, so we're still kind of talking about external reporting, that we're gathering our costs, and those costs are going to eventually feed up into inventory that will be reported on our balance sheet, right? Okay, and then from there, once you have inventory, you sell the item, you have a cost of goods sold, you have a sale, etc., right? Okay, we won't get into all that so much because you've already studied that 52 times in the financial accounting context. Okay, so we have to gather these costs, and we're going to gather these costs so that we can figure out what the value of our inventory is. Now, when we look at costs, we can put them in two broad categories. We can either put them in the category of direct or indirect. Direct or indirect. Now, often students are looking for some, precise definition of direct versus indirect, and it's really more a matter of how difficult or how easy it is to trace a cost to our product. So if a cost is relatively easy to trace to our product, then we treat that as a direct cost, we can directly relate it to the production of our product. For example, if we have direct materials, okay, materials that are used to produce that product. We can't produce that product unless we incur that cost. And so it is very easy to do what? To trace the direct materials to the cost of that product. So if we're building furniture, say a wooden table, the wood that is used for that table is a direct cost because what? You know you can measure how much wood you use, etc., to produce that table, etc., right? Okay. Direct labor is a direct cost because what? Well, we have to employ somebody to sit there and put the table together, stain the table, whatever, and we can easily keep track of their time while they're working on that table. Okay? Now, what happens if we're having glue to put the table together? It could be considered difficult to trace that indirect material, glue, to put a table together because we don't kind of sit there and measure. Hey, Charlie, when you're making that chair, if you use 3 ounces of glue out of a 12-gallon jug, make sure you keep track of how much glue you use. Now, that's not to say that you couldn't do that, but at some point, what? The cost of acquiring that information outweighs the benefit of that information. So for an indirect cost, we're going to have to allocate that indirect cost to that product using some systematic means, and we'll talk about that here a little bit today, but we'll really get into how to allocate indirect costs to product more in Chapter 2. Okay? Okay, so we have our cost, we have direct costs, we have indirect cost. Okay, direct material, direct labor are classic examples. I just gave them to you of direct cost, manufacturing overhead, and manufacturing overhead tends to fall into 3 categories, and we'll put this up again on another slide, but let's just put it here now. Okay, manufacturing overhead tends to fall into 3 categories. One, I've already given you example, is what? Indirect material. Number 2, what do you think? Good. Indirect labor. Okay, so what happens? We have a supervisor. And the supervisor is doing what? They're going around to Joe over here who's working on table number 75, Sue over here who's working on table number 37, Bill over there who's working on table number 29, whatever, okay? And what happens? They're bouncing around from table to table saying, hey, you got a lopsided leg there, whatever. You use too many dowels. Our tables are supposed to be sanded from left to right, whatever. And so it becomes a little bit difficult to sit there and keep track of how much time that supervisor spent on each one of those tables. So we say, okay, we're going to treat that as an indirect labor. We're going to have to allocate that cost of that supervisor to our various products. And we're going to talk about that allocation process here probably a little bit more next time. Okay? And then 3, I like to call others. I like to call those others. Now, every time I call them others, I think of this movie with Nicole Kidman. I don't know if you saw The Others. It's this really scary movie where these people keep coming to her door, and these people are like ghosts. They keep coming to her door, and they're like really creepy people. And then they keep trying to tell her, well, you just need to accept your situation. She's like, get away from me, right? And then it turns out that she's also dead, and they're trying to get her to accept that she's dead. And so by the end of the movie, I'm like, turn this off. Okay, so anyway, everything, the others. Okay, I don't know why I got stuck watching that movie. I'm not a scary movie guy. I'm not a sad movie guy. I can't handle either one of them. Okay, now, what happens? Others are things like depreciation. Utilities. Rent. What are we being attacked by bugs here? Rent. Property taxes. Okay, what happens? Let's talk about utilities. Let's say the lights. We have the lights turned on. We have a light bill. Are we going to sit there and say, that table used up 12 kilowatts of electricity? That table over there, because it's in the darker part of the room, only used up 8 kilowatts of electricity. It is too difficult to figure out how much of our utility bill will be attributed to any particular product. So again, we're going to treat it as an overhead item and have to allocate it. Depreciation. We don't sit there and say, well, when you were using the table, you used, 23% of our floor space for 3 days. Let's allocate that much depreciation. Let's assign that much depreciation to that particular table. We're going to have to do what? Allocate our depreciation based on some factor. Maybe we're going to use direct labor hours or something like that. Okay. Rent. Okay, you don't usually have depreciation and rent, but you could have depreciation, then maybe you're renting some additional space or whatever, right? Or maybe you have depreciation on equipment, but you're renting the building. Again, all of these things, property taxes, etc., would be too difficult to allocate, trace directly to products, so we treat it as an indirect, and we're going to have to come up with a systematic basis to allocate those costs. Okay, so again, it gets down to what? The definition is not, it's not like God came down and said, okay, children, all of these things are direct and all of these things are indirect. It's really based on what? The judgment of the company as to the difficulty to trace that directly to a product as to whether or not they put it in direct or indirect. Okay? Okay, good. Now we come over and they start giving us now our definition of manufacturing cost. And our manufacturing costs, which we really kind of saw in the previous slide, are our direct costs, which are what? Our direct labor, our direct materials, and then our what? Indirect costs. Indirect costs are our manufacturing overheads, and I'm not going to repeat those. We gave you some examples, right? All of these costs go into this product. Now, for the direct, it will what? Be traced directly. For the overhead, we're going to have to use a method to allocate that cost to this product, right? Okay. Okay, good. So a radio installed in an automobile is an example of direct cost. Okay, so what happens? Maybe this vehicle, they put the cheaper radio. This vehicle, they put the more expensive radio, right? I know when I buy a car, I look at 3 things: the interior, the engine, and the stereo that's in it. And I'm not buying a car that has a funky stereo. That's just not happening. I've got to get the tip-top stereo sound in there, right? So what happens? They can figure out the cost of that particular, maybe higher-end sound system that they put into a vehicle versus what? Versus a lower-end system. So that would be an example of direct materials. Okay? What happens? The wages that we pay someone for the amount of time, wages are usually paid per hour, right? So if we're paying somebody $20 an hour and that person spends 10 hours working on that particular product, then we know that we have direct cost of $200, right? Did I do my math right on that? Okay. Okay, good. So that one's fairly easy to trace. Okay. Now, indirect materials, indirect labor, we're going to have to allocate those. Okay, and examples of indirect might be lubricants. There's our glue, like our glue, for example, would be another example. If we're talking about sandwiches, let's say we're a sandwich shop, right? What happens? I would say the bread and the meat and the cheese that goes in that sandwich are going to be direct, right? Okay. I would say we could pretty much track how long it takes someone to make one sandwich, right? Okay. And so if it took someone, I mean, it's not going to take them an hour to make a sandwich, but let's pretend it took them an hour, and we pay that person $10 an hour or whatever, then we would allocate $10 to the cost of that sandwich, right? Okay, there I go mentioning food, right? And everybody's like, sandwiches, I forgot to eat lunch today, right? Okay, then what? Then when we get to indirect cost, okay, indirect materials, maybe the mayonnaise that goes into that sandwich would be what? An indirect material, because we don't expect them to say, well, you got a 50-gallon jug, of mayonnaise, measure how many teaspoons you put on there. Okay, that's going to be too difficult, so we'll treat that as what? Indirect, and we'll allocate it. I don't know. Sometimes students say that lettuce, when I used to go in more detail, or when I teach managerial, I go in more detail. 101, I'll go into more detail, the sandwich example. And a lot of times my students want to say, well, lettuce would be direct. Not really. You get a head of lettuce, whatever you pay for that, and then you pull a piece of it off. You're not going to say, that looks like about 1/10 of the piece of the lettuce head, so that's 10 cents. Probably not going to do that either, right? Again, it's what? The ease or difficulty of tracing these that make them indirect versus direct. Same thing with labor. We have a what? We have someone that cleans up the area so that someone can continue to focus on their sandwiches and not have to worry about how many pieces of lettuce they dropped on the floor and turn around and pick them up. And so what happens? We sit there and we're going to go ahead and we're going to take the cost of the cleaner and do what? Allocate that. Okay. In this class, we pay attention to managerial accounting. There's no option of sitting there and looking at your cell phone the whole class. Yeah. Okay. All right. Okay. Good. Direct versus indirect. Okay, again, the ease of tracing those. Now, those were all manufacturing costs, right? Manufacturing costs, the what? Direct materials, direct labor, and the overhead were all considered manufacturing costs. Okay, now you come over and we talk about what? We talk about non-manufacturing costs. Our non-manufacturing costs are going to be our selling cost and our administrative costs. Okay, and we treat these as period costs, meaning they will be expensed on the income statement as they are incurred. And we'll worry about product versus period cost here in a couple seconds, but we will expense these as they are incurred. For example, let's say we have to pay for some advertising. Advertising is a selling expense, isn't it? Okay, so we play an ad on the radio, said, come to our sandwich shop and have the most delicious sandwich you've ever had. Now someone hears that ad, and they hear that ad in December, but they don't come to our shop until what? Until January. So you're sitting there and you're saying, well, if that's the case, John, by December 31st, whatever we paid for that ad still had future economic benefits, so it should have been an asset, shouldn't it have, at the end of the year? But the accounting standards tell us, no, expense that as you incur it, because it is too difficult to know whether somebody came in December because they heard that ad, or if somebody came in what? January because they heard that ad. So selling costs are treated as a period cost. They are expensed as incurred, right? They're expensed as incurred. Okay, we do not put them as a product cost. They never hit the balance sheet. They go straight to the income statement. Administrative costs. What do CFOs do all day? What do CEOs do all day? Let's not pick on the financial people. What do CEOs do all day? I don't know. I have no idea what they're doing up there. What do they do all day? Okay, so what happens? Because we don't know what they do all day, and we don't really know when the period of benefit is, whatever we pay them, we what? Expense it in the period incurred. Okay, so administrative costs, selling costs are what? They go straight to the income statement. They're expensed as incurred. Okay? Okay, good. So that's what we're showing you here on this slide. Notice period costs, they're expensed as incurred. You debit the expense, you credit the cash, credit the payable, whatever, and they go straight to the income statement. Our product costs, what are our product costs? What are our product costs? Direct material, direct labor, manufacturing overhead, right? Those are what? First going to be captured in my inventory account, and then as I actually sell the item that was produced by those costs I incurred, my direct items and my indirect items, then as I sell them, they'll go from the balance sheet to what? To cost of goods sold. I'll credit inventory, I'll debit cost of goods sold, right? Okay? All right, so again, let's just kind of summarize some of the things that we've said, because we threw around a lot of terms, didn't we? We said what? Direct and indirect costs, right? Okay, direct and indirect costs are what? Considered direct and indirect costs, right? The definition is how difficult it is to trace to the product, right? Okay, now what happens? When we look at our manufacturing costs, we can take our direct labor, direct material that are both direct, treat them as product cost, and our what? Manufacturing overhead, which is indirect, we will treat as a indirect cost, right? Okay, and we talked about indirect labor, indirect material are obviously indirect, but then there's that others category, which is our depreciation, our rent, those sort of thing, right? Okay, now what happens? Then we have period costs, and period costs are our selling and administrative costs. They go what? Directly to the income statement, right? Now let me ask you a question. Can a selling cost be a direct cost? It's a little bit confusing. It's a little bit deceiving the way we presented this material here. That's a hint. As to the answer to that question. Can a selling cost be a direct cost? Huh? It can? So even though it's not a product cost, it can still be direct, right? It's a period cost, but it can still be direct. What's an example of a selling cost that's a direct cost? What's an example of a selling cost that's a direct cost? Come on, guys, you're accounting majors. I mean, this is the kind of crap that your clients are going to ask you. Well, wait a minute. I heard that selling costs are all indirect. What would be a selling cost that's a direct cost? And you're going to have to be in the position to say, well, client, here's what it is. And when you give that answer, they shut up. It's beautiful. And then they stop asking you those stupid questions, okay? But if you sit there and go, gee, I never spoke before about accounting, then you're going to struggle, right? When I first started the GAO, they gave me my first evaluation. They said, you need to talk more. A year later, they said, you need to shut up. The more you talk, the more you get used to it, the better you get at it. Just don't fall in love with the sound of your own voice. Once you get good at it, then you want to talk all the time. And then they tell you, you really should something. You probably should teach it yourself. One time I was on an assignment, and we were looking at how banks account for their loan loss. And Congress was interested in that because they wanted to make sure that the loan loss accounting was being done correctly, because if it wasn't, then the regulators were not getting good information to determine whether or not the banks were properly reserved for their FDIC insurance, right? So Congress is a little bit concerned about that, asked my office to go in and take a look at the loan loss accounting. So we go into this meeting with some officials from, I think it was the Office of Control of the Currency or Office of Thrift Supervision. I forget which regulator it was. And so they march in this guy who's like the chief guy there, and he starts saying, well, this is how a banking loan loss works, blah, 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 blah. And I said, well, what's the journal entries? Well, I don't care about the journal entries. And I said, well, that's all I care about. Anyone describes an accounting process to you and they can't give you the journal entries, they have told you nothing. So when we were leaving that meeting, my boss was like, you know, that guy was a director, and you probably shouldn't have told him that all you care about is journal entries, blah, blah, blah. Okay, sorry. Okay, so sometimes you got to be careful with how you articulate things. But it's true. They can't explain the journal entries to you. They're wasting your time. Okay, so I've stalled long enough that you should be able to give me an example now of a selling cost that's a direct cost. Let's pretend it's a man on the street interview, woman on the street. Hello, I'm John. I'm your interviewer of the week, and we're out here asking people at San Francisco State if they have an example of a selling cost that could be direct cost. How about you? How about you with the Elmo shirt? I'm a Cookie Monster guy myself, but okay. You like Elmo? I won't hold it against you. Who's bigger, Cookie Monster or Elmo? Cookie Monster's more famous and he's bigger. He's physically bigger. Elmo's really little. How about commissions? Commission that we pay somebody to sell that table, let's say it's a percentage of the selling price, is a very easily traced to that particular product, isn't it? So then you're saying, well, wait a minute, John, then why don't we include it as a direct as a direct cost, included as a product cost? And the reason is that what? There's a perfect matching between what? Between the commission that's paid in the period when you sell it. So for that one, even though it's a direct cost, you treat it as a period cost because you incur the commission when you sell the table, don't you? So it matches up very nicely against your sales that you generated from that, right? Okay. So again, the takeaway from this discussion is that even though selling and administrative costs are period costs, that does not mean that they are indirect, right? Some can be indirect, but they're all going to be expensed anyway in the period incurred, so we don't have to worry about any allocation to a product. Okay? Okay, good. Question? All right, good. So, huh? You don't have this one? Okay. Well, this is exciting because it's a question. This is exciting because it's a question that'll be like a question on your exam, even more exciting. You may get this very question on your exam because there are a small percentage of questions that I take off of the quizzes, that I take off of the practice midterm, and I stick them right on the... Now, I don't do this. Oh, good. Good, Michael. I don't do this so much with my accounting majors, okay? There was one time that I took the same practice midterm and handed it out as the midterm in the class. And the average was like a 72. There were some students that were sitting there like puppy dogs looking at me like, really? Shh, don't say anything. I think he did this on accident. Okay? There were other people that were like, you know, you asked completely different questions on this one than you did on the other. I'm like, no, I didn't. I asked the same exact questions. Okay? All right, so let's look at this one. Using the above information, factory overhead. So factory overhead are indirect, right? So we got to find the cost here that constitute overhead. How about raw materials? Well, raw materials could be what? Could be overhead if they are indirect materials, right? Okay, but they're telling me the beginning raw materials balance, so I don't know. I can't include that in there and say, yeah, it's automatically indirect, right? It's automatically overhead. So no, that's not it. How about indirect material costs? How about indirect material costs? How about indirect labor? Right? How about maintenance of factory equipment? Yeah, we're going to pay somebody that we're not going to sit there and say, well, let's see. You spent 5 minutes working on that machine over there to keep it maintained, and that machine then spent 2 minutes on that table. So let's see, 5 minutes versus 2 minutes. Too difficult, right? Okay, now that's not to say it can't be done, but most likely, most cases, it's going to be too difficult, and so no. That's going to be yes. I should say that's a what? Indirect cost, right? It's not direct. How about direct labor? Obviously, that's direct. Okay, so you add those up. There's your answer. Question? Which of the following will most likely be included as part of manufacturing overhead in the production of a wooden table? And you're going to recognize this from the specific example I gave. But again, it would be what? A cost that is too difficult to trace to the product is indirect, right? Okay. So, by the way, if you don't like my class, you can still drop it. You know that, right? If you don't like this, you can drop the class. You know that, right? Because I get some people that sit there like this already. Okay, you can still drop the class. I didn't come to your house this summer and say, hey, guess what? I'm going to be teaching Accounting 305, come on. The university decided you need this class, and they decided that they needed another section so you could fit, and they asked me to teach it. And I didn't sit there saying, hey, can you add an extra 305 class so I can teach it? I also didn't do that. Okay, so little enthusiasm would be nice. Okay, all right, so what happens? We sit here, and how about the amount paid to the individual who stains the table? That's going to be direct because what? That individual just tracked the time they spent to stain it, right? Easy enough. How about the commission paid? That's what? That's direct, right? Huh?
It's also selling, right?
It's selling, but it's, yeah, so you're right. It's not a product cost in manufacturing overhead. It is a product cost, and it's also what? Direct, and our manufacturing overhead, our overhead is indirect. So it gets a little weird, right? We're using different names for the same thing. Okay, we're calling what? We're calling the selling cost, the commission, a direct cost. Meanwhile, it's not a product cost. Manufacturing overhead is an indirect cost, and it is a product cost. So it's at some point, it's kind of like you're trying to tease your younger brother or sister. Mom, he keeps saying that manufacturing overhead is a product cost and it's indirect. And then he says that sales commissions are period costs, and then he says that they're direct costs. That's right. Okay, so it gets a little bit weird, right? Okay, so commission is going to be, it's not a manufacturing cost. Good, it's a selling cost, and it's also what? It's direct. Okay, the cost of glue. The glue is like mayonnaise, isn't it? It's too difficult to trace. Now, don't eat it, okay? But it's too difficult to trace to anyone, so we would probably have to include that in our overhead pool and allocate it, okay? The cost of the wood, probably pretty easy to trace, right? Okay? Okay, good. All right, let's take a look at this one, and they want us now to pick out our manufacturing overhead. So we are going to pick out our what? Our direct labor, direct materials, and strike that cut. Okay. Edit. I have to edit that later. No, I won't edit that later. We're talking about manufacturing overhead, so we're going to be picking up indirect items here, right? Manufacturing indirect items. Okay. So how about factory supplies? Is factory supplies first, is it a manufacturing cost? Well, what do you do? Okay, but is it a manufacturing cost? Because we have to figure out manufacturing overhead. So it is a manufacturing cost. Yeah. What do you do in factories? You manufacture things, okay? So factory overhead is going to be a manufacturing cost. Is it indirect? Are factory supplies indirect? Yeah. Supplies, by its very nature, indicates that it's what? God damn it, I don't know why this keeps doing this. That jumping line like I'm having a heart attack up here. I don't know why it keeps doing that. The 7,000 is going to be what? Is going to be indirect. Factory supplies, by their very nature, are things that are smaller, paper towels type thing, whatever, right? Shop rags, whatever. So that's going to be too difficult to trace, so we'll treat it as an indirect. How about administrative wages and salaries? They are what? They're indirect, but they are period costs, not what? Not product costs. Okay, so we're not going to include that. They're not a manufacturing cost. How about direct materials? Well, it is a manufacturing cost, but it's not what? It's not indirect, therefore it's not overhead, right? How about sales staff salaries? Sales staff salaries are not a manufacturing cost there because they are what? They're not a product cost, they are a period cost, aren't they? And the fact that they call it salaries indicates to me that this is the part that they make regardless of whether they sell anything or not. So it's also probably indirect. But it's not a product cost. How about factory depreciation? That's part of the all others category, isn't it? Okay, it's indirect, too difficult to trace, and it's depreciation on the factory. We manufacture things. How about corporate headquarters building rent? Administrative costs, that is going to be expenses incurred, right? It's not a product cost. It is not a manufacturing cost. How about indirect labor? Yep, that's obviously indirect, and it is a product cost. How about marketing? Marketing is going to be a selling cost. It will be treated as a period expense. How about direct labor? Well, it is what? A manufacturing cost, but it's not overhead, right? Okay, so you add these together, and please God, I hope you get, 82,000. Do you get 82,000?
But the earlier slide it doesn't say it correctly. It's just missing a zero.
Which one? Which one's missing a zero?
On the answer right now, you fixed it. It's correctly done, but right now the one that's on island is wrong. That's why.
I got this right off of iLearn. This is the same thing I put up on iLearn. What kind of computer do you have? You have a Mac? Yeah, get a Microsoft Surface. It'll look fine. Yeah. Sometimes there's a little bit of a compatibility issue. One of the things that sometimes helps with that, Michael, is if you turn it into a PDF. The slides, you know how to turn the slides into a PDF? If you turn them into PDF, sometimes they're a little easier to follow. You guys know how to turn slides into PDFs, right? Okay, well, I've had to go through a whole I had to spend a whole class time before showing classes how to do that. So, okay, good. All right, let's take a look at these, and don't worry about this column right now, fixed versus variable. We're going to get to that a little bit later, but let's just use this exercise for product or period costs. So, how about executive salaries? Period, good. How about direct labor? Product, good. How about direct materials? Product. How about depreciation of factory? It is product, even though it's indirect, it's product cost, right? Okay. How about indirect labor? Product. How about delivery expense? Delivery expense is, even though it could be considered what? Even though it could be considered direct, because whatever you had to pay to deliver that, it is still treated as a what? Period cost. It is treated as a selling expense. Okay, freight out is a selling expense, and we can treat it as such because it matches very nicely with the sale, doesn't it? Okay, how about television advertising? No, that's going to be treated as what? As a period cost. That's selling. That's a selling cost, right? Okay. How about indirect materials? Those product. We'll worry about fixed versus variable later. Did I do something wrong over here? You guys are looking at like you found a mistake that I made. I got it the same. Is there a question? Is there a question? Okay. Don't be shy. You're all business majors, aren't you? Accounting concentration? Business majors? Have you ever seen them give the business award to the shy business person? And now the shy business person of the year award goes to John. Do they have such an award? The award for the business person here, the business person with the biggest inferiority complex goes to no. They don't have any such award. You know why? Because those aren't the people that are successful in business. The people that are successful in business are the people that walk in and go, let me tell you how all this is done. And everybody else has to go, okay, here he comes. Let him do his thing. And they do their thing. And then everybody goes, good job. Meanwhile, everybody goes, oh, what an ass. I hate that guy. Everybody keeps clapping because now they're afraid of him.
But I think it's backed up by knowledge, and we're basically in the process of gaining that knowledge, so kind of just a bit shy, I suppose.
Well, I don't think that a person should go off making incorrect statements and stuff. Okay. But two things. Number one, in here, we're in a safe environment to learn. If you say the wrong thing in here half the time, okay, then the next time you're in an environment where you happen to say this, maybe you say the wrong thing only 20% of the time. And then the next time when you're in another opportunity, you only say the wrong thing 2% of the time, whatever. So the more you practice with it, and in here, there's no penalty. There's absolutely no penalty, okay? Now, that does not mean that a person, because they don't know the answer, shouldn't be saying, well, look, the possibilities are, the potential is blah, blah, and we can look into some of the nuances, whatever. You can still do that and give yourself some wiggle room, okay? But this idea that I'm not going to say anything until I'm absolutely certain is something that you have to start to separate yourself from a little bit, because in business there's an expectation that you are the answer person, you are the go-to person. Okay, again, that doesn't mean that you're going to sit there and be a fool with things and start talking about things you don't know. Sometimes the best answer is that's not my area. And if it's not your area, you just punted on that particular thing. People find out I'm a CPA and they start giving me some tax question. Well, my mother and my father and and I was wondering if if I can get a deduction for that. And I take a sip of my beer and I say, that's not my area. I know someone who can answer that, though. Do you want their number? So you can punt on something. But if you're trying to say that it's your area or something, then you probably want to be in position to say, well, there's some nuances there. I've understood this and that, but let me get back to you. But just sitting there stunned silence is usually not a good sign. Okay, and I'm here to try to break you out of that. Okay, now, this slide, have you guys heard of satellite radio? Okay, satellite radio, they have specialized channels. Like there's the rock and roll channel, there's the rhythm and blues channel, there's the spa channel in which they play the sounds of bubbles bubbling, right? Okay, if they had a Who Cares channel on satellite radio, this would play 24 hours a day. Okay, not 24 hours a day. This would have to play at least 3 times in an hour. Okay, on the Who Cares channel. Okay, but it is a way that these costs are referred to, so I have to teach it to you. Okay? So what happens? Our direct labor and our direct material are called prime cost. They're called prime cost, I guess. I don't know. This was around before I was born and they didn't consult me when they started putting these labels on it, okay? I guess they're prime cost because you can't have the product unless you have direct materials and direct labor, I guess. I kind of get the direct labor and manufacturing overhead are conversion costs because what happens? You have a bunch of materials sitting on the floor, right? And there you can't sit there and say, materials, rise up into a table, become a table. You have to do what? You have to get a little labor, you have to get a little glue, and put those materials into the form of a table. So we're converting materials to product, aren't we? So I kind of get that. Prime, why these are prime. Like I said, who cares channel? I don't know. But just remember that what direct materials and direct labor are prime costs. Direct labor has two identities, doesn't it? It's also considered a conversion cost, as is our manufacturing overhead. Okay? Okay, good. So, let's test that dismal definition, which is property taxes on a manufacturing facility are classified as, first of all, property taxes are example of what? Is it indirect or direct? Indirect, good. Therefore, it is manufacturing overhead, isn't it? So if it's manufacturing overhead, is it a period cost? No, our selling and administrative costs are our period costs. So that's a no. Is it a conversion cost? And per our last slide, yes, because we have what? Raw materials and we convert them to product by putting a little labor in there, putting a little indirect materials in there, whatever, to create that product, right? Okay. Okay, good. The property taxes on a factory building would be an example of a prime cost. Prime costs are direct labors, direct labor, direct materials, right? Okay. Our what? Conversion cost. Is it a conversion cost? Yes, it is, right? Because it's going to be part of my manufacturing overhead. Now be careful, guys, because some of the trick questions, notice in both of these, it was manufacturing facility, it was factory building. There are some questions where they'll ask you the same kind of thing about the administrative offices. And then the answer is going to change, isn't it? If it's administrative offices, rent or property taxes, then what? Then it is no to both of these. It is neither prime cost nor is it a conversion cost because it is a period cost, right? Make sense? Yeah, if this had said, say, property taxes on corporate headquarters, then it is a period cost. Therefore, it is what? Neither a prime cost nor a conversion cost, because prime cost, conversion cost, prime are direct materials, direct labor, conversion or direct labor, and manufacturing overhead, which are all product costs, right? Okay, good. Now, let's talk about variable cost versus fixed cost versus mixed cost. Okay? Now, variable cost will increase or decrease with the level of production. Okay? So what happens? The more product we produce, the more my variable cost, the less product I produce, the less my variable cost, right? Okay? So let me ask you, do you think direct materials is variable or fixed? It is variable because what? Because it will rise and fall with the level of production, right? Okay. How about direct labor? Variable because it'll rise and fall with the level of production, right? Okay, good. Now, some costs will stay the same regardless of the level of production. Okay, so do you think that rent on my factory building is fixed? Oh, obviously, right? Is fixed or what? Or, yeah, I can't even finish the stupid question. You know the answer. It's fixed, right? Okay. How about rent on my factory building? Probably fixed. I mean, there could be, and this is really beyond the scope of this class, they have these things called rent kicker. And a rent kicker, they'll say, well, your rent is $5,000 a month unless your revenue exceeds, say, $500,000, in which case any amount we want a piece of the action, we want 5%. And you might do this because let's say you have a really cool building in Hayward, and you want to charge, so much a month, but if you charge too much per month, nobody will pay that for a building in Hayward, but yet you feel that someday this neighborhood in Hayward is going to be the place to run a business, right? So what do? You build in a little rent kicker in there to protect yourself that if the business starts going through the roof, you get a piece of the action, okay? And if that's the case, then rent could be what? A mixed cost, and that it's fixed up to a point, and then it starts to go what? Starts to go variable after that. Okay, but rent is typically what? A fixed cost. Okay, now I've given you a description, an example of a mixed cost, probably not the one I wanted to lead off with as an example of a mixed cost, but let's say your utility cost. Utility costs tend to be mixed because what? If you want the PG&E service to come to your business, Pacific Gas and Electric, right? You are going to have to pay so much a month. Even if you sat there with all the lights off and didn't move for a whole month, they're still going to send you a bill, and that bill is going to maybe be $25, $30, $40, whatever, right? That's for the right to have the service. Okay? But then as you start to what? Manufacture, use up electricity, whatever, then that bill starts going up, doesn't it? So mixed cost is what? One that is fixed to a point and then what? And then becomes variable after you start using. Okay? These days, everyone pays a flat amount for their cell phone bills, but it used to be cell phone was the classic example. I got to pay $20 a month for a cell phone, and then when they used to charge you by the minute, then it starts to go up at that point as you start to use it. These are mixed. Okay? So, question? It's probably mixed, although we don't usually track, utility costs by item. Okay, it's just how many kilowatts did we use, but electricity tends to be a mixed cost. That's correct. Okay, and we said depreciation is a fixed cost. Unless you're using the units of activity method for your depreciation, now you've got what? Now you've got a variable cost, don't you? The more you use that machine. But then it could be mixed because even under units of activity method, units of production method, you may have a fixed amount of depreciation that you take because what? Wind blows, time marches on, and even if you never use that piece of equipment, eventually it'll fall to dust. So companies will go ahead and they maybe will use a fixed component. And of course, if you ever were to look at empirical evidence as to how much entities use the units of activity method, very few entities use units of activity because what? There's a whole nother set of record keeping that has to be done beyond just what? Taking the life of that item and dividing it into the depreciable base. You got to figure out how much did you use it, right? And sometimes students will say, well, that's not that hard. It's not that hard if you're talking about one piece of equipment. You're talking about one vehicle. If you're talking about a whole fleet of vehicles, it could start to get a little bit onerous. And so that's why a lot of companies just use straight line. And if you're using straight line, then it's fixed, right? Okay? Okay, but when we look at this, when we talk about our variable, our direct labor, our direct materials tend to be variable, don't they? Just now tying this to our discussion as to our product costs. Okay. Our what? Our manufacturing overhead. By the way, I almost always will abbreviate manufacturing overhead MOH, Mo. Hey, Mo. Hey, Larry. Okay, you guys don't know that. Okay. I always pretty much put it as MOH. Okay. Our what? Fixed, our manufacturing overhead, it's probably a better way to say it, tend to be what? Fixed cost or mixed cost, don't they? Okay. Okay, good. So we come over. And an important thing to think about, because for some reason test questions like on the BEC section of the CPA exam like to ask this all the time. Okay, and so I want you to be aware of it here. So this is not so much something that you talk about in practice so much, but in the academic world they love to ask about this. So I want to make sure that you're aware of this. Okay, which is that if we're talking about in total, our fixed costs stay the same regardless of the level of production, right? Our variable costs do what? Move with the level of production. More production, more total variable costs. Less production, less total variable costs, right? Okay. If you look on it on a per unit basis, variable costs are fixed on a per unit basis. If our variable cost is $5 per unit, it stays $5 per unit regardless of the number of units you produce, right? Okay. Meanwhile, our fixed manufacturing costs tend to be variable on a per unit basis. Now, this sounds like the kind of thing you're teasing your brother with again, right? Mom, he just said that fixed costs are variable costs. Well, fixed costs, I didn't say that, Mom. Fixed costs are what? Are not variable costs. They are what? They are variable on a per unit basis. Okay? They fluctuate on a per unit basis. Let's just go ahead and use an example. So let's say my fixed cost equal 100,000. And let's say I produce 1 unit. Not a trick question. What are my fixed costs then per unit? Not a trick question. What are my fixed costs per unit? Not a trick question. So you got to be careful in my lectures, because all of a sudden I'll ask you a question like that, and when everyone goes, then I know you weren't paying attention. What's my fixed cost per unit? 100,000. Good. My fixed costs are going to be the same regardless of the level of production, right? But let's say now I produce 2 units. Now what's my fixed cost per unit? Not a trick question. 50,000. So the fixed cost per unit on a per unit basis, total stayed the same. On a per unit basis, it varies with the level of production, doesn't it? Okay, let's say my fixed cost, again, they're going to stay the same regardless of level of production, but now my level of production is what? 3 units. You know where this is going. Now it's what? 33,333 and 33 cents until I produce that last item, in which I'd have to make it 34, so it rounds out. Right? Okay? Okay, so again, important slide, because in the academic world, I'm going to have to ask you something like this, okay, in which what? In total, fixed costs stay the same regardless of the level of production. The variable costs will what? Increase and decrease with the level of production in total. Okay, on a per unit basis, what? Fixed costs stay the same. They're in effect fixed regardless of the level of production. And what? Our on a per unit basis, our fixed costs are what? Variable. Okay? Okay, good. All right, let's go ahead and let's take a look at a question. Which of the following costs, if expressed on a per unit basis, would be expected to decrease as the level of production and sales increases? Okay, so just look back at what our, on a per unit basis, our fixed manufacturing cost did what? Decrease as our production increased, right? So fixed cost per unit decreases as the level of production increases. Sales commissions are going to be what? They're going to be direct, aren't they? Okay, so they're going to increase and decrease. Stay the same, I should say, on a per unit basis. Variable manufacturing overhead is a variable cost. It's going to be what? On a per unit basis, stay the same, isn't it? Okay, direct materials are again a variable cost, and so they're going to stay the same, I should say, on a per unit basis. Okay? Question? Which of the following is an example of a cost that is variable with respect to the number of units produced, and what? Direct labor costs, where the direct labor force is adjusted to the actual production. More units you produce, the more your variable costs in total. The less units produced, the less. Okay? These other costs are all fixed, aren't they? Okay. Unit variable costs do what? Remain constant. Unit fixed cost will do what? Decrease as the level of production increases, which is what's happening in this example. Right? You go from 1 unit to 2 units to 3 units, your fixed cost per unit decrease. Okay, good. Let's talk about now how we're going to allocate our manufacturing overhead to our products. Okay, we're going to use that using something called a predetermined overhead rate. Now, what a company will likely do is they will look at data that goes back over several years, several months, whatever, and they will use that data to predict how their costs are going to behave in the future. And then they'll use that predetermined overhead rate to allocate their cost as they develop their product, because we have to allocate those overhead costs, right? Okay, we'll come up with some allocation base that we'll use, and often it is direct labor hours. Okay, now I want to warn you, though, that direct labor hours is used a lot in our examples, but it is not the only driver of our overhead costs. It is not the only activity that we'll use to figure out what our overhead costs are. Okay, so what happens? When we look at our overhead costs, it is a what? They tend to be variable. They tend to be, they tend to be what? Mixed and fixed, don't they? Okay, so if we have fixed and mixed components, then we can express our manufacturing overhead as this equation, y equals mx plus b, where x is the number of units, m is the what? Variable cost, which will vary by the number of units, and b is what? Is the fixed cost, right? Okay, so when you're looking and you're seeing this fixed line, that's going to be what? Our fixed cost, and that's stuff like our factory building depreciation, our factory building rent, etc. The fixed portion of the light bill, But then what? Because our manufacturing overhead can also be a mixed cost, then there's also a variable component, isn't there? Okay, so we can express our manufacturing overhead by just understanding y equals mx plus b. Okay, now you may be saying, well, y, which is the total cost, John, is this being expressed as a plus bx? I mean, why are you using these weird letters? We learned in algebra y equals mx plus b. I see now that you have tied the what? The total cost, total overhead cost. I see that you have tied that to a more representative equation here, you know, the items, the elements of the equation, which is variable cost times the units plus fixed cost equals my total manufacturing overhead cost, right? Okay, so why these other letters? Well, these letters are nomenclature, if you will, that is used in regression analysis. Something called regression analysis. And what regression analysis does is it basically takes different data points and maps them to a line like this. Okay, so even though the data points may not line up exactly along this line, so though maybe one will be on there, maybe even not one. What regression analysis does is it takes these data points and maps them to a line, and by that they are able to tell you how tightly correlated the what overhead costs are to whatever activity you've lined them up with. And it is a statistical method that is more reliable than, say, a very basic method like we're going to be talking about in here, which is the high-low method. High-low method will take 2 points and just say, there, all the costs line up along that line, when in reality they do not. Okay, but for our purposes, I really don't care how you come up with the numbers that constitute our variable costs and our fixed costs to predict what our total overhead costs are going to be at whatever level of production we decide we're going to have in the upcoming year. What I care is once you are given a variable cost and a what? Fixed cost, that you know how to then parlay that into the total manufacturing overhead, and then how to use that to come up with a predetermined overhead rate. And then use that predetermined overhead rate to do what? Allocate our cost to the cost of the product. Okay, so that's what we're going to be looking at here in the next few slides, is how will we come up with the factors that constitute basically our variable cost and our fixed cost. Okay, so again, they give us this y equals ax, and again, for our purposes, I guess I should put total manufacturing overhead cost, but whatever, total cost, total manufacturing overhead cost equal fixed cost plus the variable cost times the number of units that we produce, right? Okay, so in this example, they tell you, well, look, if your direct labor hours are $3 per direct labor hour, and you use 2,000 direct labor hours, and your fixed cost is what? $40, then your total manufacturing overhead cost in this example, hello, would be $100. Okay. Okay, good. Now, what we're going to use is the high-low method. And again, I'm just showing you the high-low method, guys, so that you get some practice with using a very basic method, again, to figure out what my variable cost per unit is going to be and what my fixed cost per unit is going to be. Okay? So what we're going to do here is we will have different points that will line up, and we're simply going to pick two of the points. It's supposed to be a straight line, so humor me. Okay, we're going to take two of the points and we're going to do what? Connect them and say, there, all the cost lined up along those lines. Now, they don't really. Okay, so it's a very basic method, isn't it? Okay, regardless of the basic, the simplicity of the method that we use, it doesn't matter if we allocate too much or too little to our product Because at the end of the period, if we have allocated too much or too little, power of the pen, we just make an accounting adjustment to fix it at the end of the period. So really, the sophistication of the method is really not that important. Okay, but there are more sophisticated methods that we could use. Okay, but anyway, we're going to use high-low. Okay, so what happens? We have these various total costs. These are the Y's, aren't they? And then we have these various maintenance hours. These are the X's, aren't they? This is the driver, maintenance hours, whatever. Okay, and our variable cost, why? Why does it insist on doing that? Our variable costs are going to be equal to M, aren't they? God frickin' thing. Are going to be consistent with the slope of the line, aren't they? Okay, and to get the slope of a line, you do what? You take y2 minus y1, and you divide that. That looks like more like an L. Y2 minus y1, and you divide that by x2 minus x1. That's how you come up with the slope. So that means that we should be able to take what? Total cost, and with the high-low method, total cost at the high, and total cost at the high, and you just find your high and your low month. Total cost at the high is what? 9,800? Total cost at the low is what? 7,400? So that's where they got that 2,400. Okay, and then we do the same thing for our activity. Our high level of activity was what, 850? I'll pay somebody $10 to tell me why that's doing that and to get it to stop. I mean, they charge us enough for these things. Can't they like make them not do these stupid things? 850, and our what? Activity at the low is what? 450. So that's where they got that what? That 400 difference. So you take the what? Change in Y, if you will, change in total cost divided by the change in X, the number of units. That gives me the variable cost per unit, doesn't it? So now that I have the variable cost per unit, which they've calculated here at $6, I can use that to figure out what my fixed cost should be, right? Okay, so what do? I come over and I take the what? Total cost at 9,800 minus the variable cost per unit times, and in this example they use the high. Do you like to be high or do you like to be low? It's your choice. Some people like to be low, some people like to be high. I like to be high. I don't know. You like to be low? Doesn't matter. Because you're saying that those what? Costs lined up along that line, right? Okay, so you could use the high or the low. In this example, they use the high level of activity times the variable cost per unit. That's my variable cost. Well, if my total cost is 98 and my variable cost at that level of production of 850 was 5,100 units, that means that my fixed cost must be what? 4,700? Now you can see the very basics here, and that what? The points don't line up along that line. If we were to sit there and put another data point in there for anything other than the high and the low month on the high-low method, we would get a different answer, which means that those costs are not behaving perfectly along that line, right? We just pretend like they are under the high-low method. So it's a very basic method, right? Anytime we start talking about, things in business and science, and we use the word pretend, that means it's not a very that scientific, right? So we're literally pretending that it lines up along that line. Now you say, well, that means it's going to be wrong if you pretend. Yeah, we will allocate too much or too little to our product. And we'll just fix it at the end of the period by making an accounting adjustment. Not a problem. We got this. Okay? Okay, good. So now that we know what our fixed cost is, we have an equation for this line. Y equals what? Total cost equals 4,700 plus variable cost per unit times the number of units, right? So let's say we produce 1,000 units. What's our total manufacturing overhead cost going to be? Who wants to set that up?
47 plus 6 times, you said 1,000 units?
Yeah, I think 1,000's okay. It's not crazy out of the range of what they've provided us in this example. So, yeah, 1,000 units.
6,000.
Right. Well, $6, right, times 1,000 is 6,000. Good. Okay. And so that means that my total overhead costs I'm estimating to be at, if I'm thinking next month or next year I'm going to produce 1,000 units, I'm thinking that next month my total overhead costs are going to be 10,700, guys, if I'm doing my math right in my head. So now we've predicted what our total overhead costs are going to be in the future, right? Right? Okay, now what happens? Let's say they're direct labor hours. Let's just pretend that this was direct labor hours. So what happens? We take this 10,700, we divide it by the 1,000, not dollars, $10,700, and we divide it by the 1,000 direct labor hours. God, I don't know why there's certain things that just bother me. The older you get, the more little things bother you. For example, it bothers me if I'm going for a jog and a car, because I go around in a circle, and a car comes by the same spot like 3 times in a row. It bothers me because I start doing the math, because the car comes right when I'm ready to cross that same thing, right? And I jog around the block 5 times, and 3 out of the 5 times a car's there. Somebody's messing with me. That car should not have been here 3 times. It's not the same car. If it was the same car, I'd run. Okay, it's a different car. Okay, but there should not have been a car that met me in that spot 3 times in a row to get in my way. So we have to do this whole thing. You go, no, you go, no, you go, no, you go. Okay, those kind of things start to bother you when you get older. Okay, like that pen jumping. Okay, so 10,700 divided by what? Direct labor hours gives me a predetermined overhead rate of how much per direct labor hour? How much? Okay, this is the easiest question I'm going to ask you all semester. 10,700 divided by 1,000. They've got this thing called calculators. You should try them, okay? You put the number in, you hit whether you want to divide, add, subtract, whatever, and then you hit that little sign, and then you hit equals, and guess what? It gives you the answer. Now, I know that when you were in elementary school, the teacher said, oh, don't use the calculator because your brain will turn to mush. Okay? Your teacher was not an accountant. Okay? God made calculators for accountants. God looked down on accountants and said, oh no, we can't have them doing all that without it. Since the 12th century, they've been sitting there doing this without calculators. Let there be calculators. Okay, so God made calculators for accountants. So you get it and you use it. So 10,700 divided by 1,000, Michael, is how much? $10.70 per direct labor hour? Okay, good. Now what happens if the wooden table incurs 3 hours of labor time? direct labor time? We would take what? 1070 times the 3 hours, and we would allocate what? $30.70 to the cost of that table, right, for our overhead. Did we achieve the objective? We took all of those overhead costs, those things that were difficult to trace, and we've allocated it now, right? Now someone will say, well, wait a minute. Maybe it's not exactly 1070. It's okay, because by the end of the period, if we've allocated too much or too little to our jobs, click, we just adjust it. And I'll show you how to do that next time. Okay? Okay, so the takeaway from this, though, is what? You come up with a way of predicting your variable cost per unit, your fixed costs, and then you use that to what? Predict the way your costs will behave at different levels of production. You then use that to come up with a predetermined overhead rate, and then you use that predetermined overhead rate to do what? Allocate those difficult to trace costs that were giving us all those trouble. We say, hey guys, get mapped to the what? Product at this rate, and if it's a little off, we can adjust it at the end of the accounting period.
So whether you use the higher or the low, you get the 4,700, right?
Whether you use the higher or the low, you will get 4,700. That's right. Yes, but it has to be the higher the low. If you pick those other numbers, unless they so happen to miraculously line up on that same line, so maybe you would hit 3 points with that line that you drew between the high and the low, it's not impossible, it's highly unlikely, then yes, you could pick another one. But more, almost 99.9% of the time, none of the other observations will line up on that same line. You basically forced that line and said, there, that's my variable cost under the high-low method. Okay, and I don't want to get into regression analysis in here because they teach you that in 412 or something, whatever. Let the nerds, they think we're nerds, they're nerds. Okay, let them do their thing. Although it might not be a bad data analytics subject, it might not be a bad thing that we can maybe get someone in here to talk to us about how you might use data analytics for this kind of thing, where now instead of using, a sample of data, because they can move so much data with these software now, you might be able to take the entire universe of observations going back however far you want, doing some adjustment for them for future potential factors that will affect that, and really come up with a very reliable number, right? For your overhead rates. But from an accounting standpoint, who cares? Because at the end of the period, if we've allocated too much or too little, we just adjust it. So, okay, all right, let's try this question, and then we're going to get out of here, guys, and go to what do they call that? What's the name of that? ASO, Accounting Student Organization, Library 121. We'll go over there. What I like about bringing my class there is we take over the event. Okay, so we'll go over there. We're going to start pushing people around. Get out of our way. Accounting 305, Section 4 is here. Okay, now, what I'm going to ask you to do is we're going to do this one, and then for kind of homework, look at the quiz questions, and when we reconvene next week, we'll start with those. We'll work those together, and then we'll jump into what I'm calling chapter 2/3. Sound like a plan? Okay. All right, but let's go ahead. Now, this question gave me readouts of regression analysis here. Okay, so they did a regression analysis, and this was the readouts of regression analysis. But then when you read the call of the question, it says using the high-low method to estimate cost behavior, 420 maintenance hours in a month would mean the maintenance cost would be budgeted at, okay, so let's just use the high-low method. So we have to find the high month, we have to find the low month. Now, if I were to give you a question like this on your exam, I would recommend you use a highlighter to find yourself the high and the low. Because I don't know about you, once I find the high and I start looking for the low, I lose the high. So what's the high month here? Is that the high month? 4,470. And the level of activity is 520. Okay. And then what's the low? 2820 and 300. Aren't you glad we highlighted the high? Okay. Then you go ahead and you do what? You start doing the math on that. We need to get the what? Variable cost per unit, which is 4,470 minus what? 2,820. Calculators. Other than Michael. Michael, you got this number? 4,470 minus 2,820. Huh? 1,650, you say? Okay, good. And this is what? 180? 280? 220? Okay, good. And when we take 1,650 and divide it by 220, we get what? 750? 7.50, Michael? Okay, good. Okay, then they wanted us to what? Then we had to figure out the fixed cost. And fixed cost, you want to be high or low? You want to be high, okay. 4,470 minus what? 750 times minus 750 times, huh?
You wrote 4,740.
4,470
It's
is what it's supposed to be. Okay, 4,470 minus 750 per unit times how many units? Good, 520. Doing the math on that, I get what? $570. So that's my fixed cost, isn't it? Equals my fixed cost. Right? And then I simply take what? My fixed cost plus my variable cost per unit times the number of units they asked me to calculate the total cost for in this example. And that gives me 3,720, the answer to this question. Okay, I could give you the same exact question on your exam, and then I'm going to say, what is the predetermined overhead rate? What's the predetermined overhead rate? No, that's the variable cost per unit. Predetermined overhead rate. Come on, guys. You got to remember what's happening from one slide to the next here. We take 3,720 and we divide it by what? By the 420 units. And that's my predetermined overhead rate. Right?
So that's what you're going to budget for next time?
That will be my budget of what I think every time I spend a direct labor hour on a job, or whatever this is, what is it? Hours of activity, whatever the hours of activity is, say direct labor hours. Every time I spend a direct labor hour, what's 3,720 divided by 420? Where's the calculators? Huh? 8.86. Okay, that's 8.86 per unit of activity, say direct labor hours, 8.8. God. Times, and if I spend 100 hours on a job, that probably wouldn't. That'd be quite a few hours for one job. If I spend 10 hours on a job, that means I'm going to allocate what, $80 and what? How much? 88.6 dollars to that particular job, right? And I use that to estimate how much overhead cost is associated with each job, right? And if my number's a little off at the end of the year, so what? All that means is what? That this total overhead cost number that I predicted was wrong. And it probably will be wrong because costs refuse to be linear. But if they're close enough to linear, then I can use this so that I'm just, not completely off on what I'm allocating to any one product or anything, right? Okay? Question? All right, guys. If you're going to the ASO welcome night, I will give you 10-point extra credit for that. You need to go over to library 121. And don't walk up to the middle while, Rich Gunn from BPM is speaking. And so, look out, Rich. Hey, Rich, be discreet about it. Go ahead and take your picture indicating that you were there. Okay? All right, guys. I'll see you over there.
Quick question.
Mm-hmm.
How do you, is the Y always a bigger number? Like when you're determining the X and the Y of the numbers?